So, hello guys, all my lovely students. Today we'll be discussing RTP November 2024 for financial reporting chapter. Um, so, on a preliminary analysis of November 24 RTP, what I have observed is there is nothing which is significantly difficult or incrementally new concepts that have been added and all. Most of the questions are already tested or they have already been in ICS resources, RTP, MTP study material somewhere or the other, except for one or two questions which we will be anyway solving them, and in fact we'll try to solve the entire RTP as such. So on that note, let's start off. Let's see the first case. The scenario number 1 is given on Ind AS 115. So D Limited prepares financial statements to 31st March each year. Following information on revenue transactions are relevant to the year ended 31st March 20x7. So on 1st October 20x6, D Limited sold a product to a customer for rupees 1,21,000. This amount is payable on 31st December 20x8. Wait there. So the date of sale happens to be 1st October, but amount collection is 31st December 20x8. That's clearly 2 years and 3 months. So the moment you read this kind of a case, what should ring in your mind is this is a sale with deferred settlement terms. So definitely financing component interest will be included, which you have to eliminate it while recognizing the revenue. So time value concept will be definitely there. The manufacturing cost of the product for D Limited was rupees 80,000. The customer had a right to return the product for a full refund at any time up to and including 31st December 20x6, which means if I draw up a timeline like this, so today is 1st October 20x6, 31st December x6 is the time what you have given to the customer to return the goods and obtain full refund. In case he chooses to retain the goods, then in that case he will pay you money only on 31st December x8. So this period is the time what we have given to the customer for making the payment, and 2 months time we have 3 months time we have given so that he'll make a decision whether he would like to continue with the goods or he can return the goods. At 1st October 20x6, D Limited has no reliable evidence regarding the likelihood of the return of the product by the customer. So as on 1st October 20x6, you do not have any clarity about whether the customer is going to hold the goods or he is going to return the goods. No reliable evidence regarding the likelihood of the return. So if you see, based on your past experience, if you have observed that this customer is most likely going to accept the good, then you can recognize it as revenue immediately. But when you don't have any such evidence, it won't be that prudent to recognize the revenue on 1st October 20x6. The product was not returned by the customer before 31st December 20x6, and so the right of return for the customer has expired, which means today on 1st October 20x6 you sold the goods. For next 3 months the customer did not return the goods. That means indirectly saying that the customer has eventually accepted the goods what you have given. On both 1st October 20x6 and 31st December 20x6, the cash selling price of the product was 1 lakh rupees. A relevant annual rate to use in any discounting calculation is 10%. So anyway, what are the questions that will be asked on this? We will see to that. But in general, let's talk like this. You are busy and preparation of financial statement for 31st March x7. Okay, that's your financial year ending. So on 1st October 20x6, when you have actually given the goods to the customer, you don't have any past experience which indicates that the customer will actually accept the goods. So in the absence of such evidence, it is not prudent to recognize this variable consideration. That means, see, whether the money will come or will not come the goods will be accepted or not, that next 3 months only we'll be able to know until the customer intimates or does anything to the goods which signifies the acceptance of the goods. So for the next 3 months, it would not be prudent for us to recognize revenue. So we will not recognize any revenue on 1st October 20x6. So when will you recognize the revenue? Of course, since the time period for rejection elapses on 31st December, so 31st December x6, the moment it's over, immediately you can recognize revenue. And next question is, how much revenue can you recognize? See, 1,21,000. The question clearly has told you that the cash price of the goods is 1 lakh rupees. but the amount what the customer is going to give you is 1,21,000 after 3 months. 1,21,000 after 3 months. So, and the question also has given you discounting rate. So divided by 1 plus 0.10 whole square, that will be also equal to the same 1 lakh rupees. So cash selling price and present value both are same. See, in this sum they both are same. So revenue will be recognized on 31st December 20x6 at rupees 1 lakh. Suppose the discounting rate is given not as 10%, but they have given you that any transaction between D Limited and the customer, a standalone financing transaction, will happen not at 10% but at some 14% or something like that. In that case, 1,21,000 you will be discounting using 14%. In that case, the answer won't be 1 lakh, it will be definitely less than 1 lakh, around some 92,000, 93,000. In that case, revenue must be recognized only at such amount and not at the normal cash selling price. In this sum, the problem does not arise because both the amounts are same. The cash selling price as well as the present value of your future cash inflow both are same. So as such, pretty much our discussion is fine. Now let's see what questions are being tested on this. Number 1. When and by what amount the revenue be recognized with respect to sales made on 1st October 20x6. Sale is made on 1st October 20x6, but when are you going to recognize the revenue? As just now discussed, it will be recognized by 31st December 20x6. Out of the 4 options, there is only one option, 31st December, one option, that too at 1 lakh rupees obviously. So the first one is done. Coming to the second one. What will be the amount of finance income to be recognized with respect to sales in the year ended 20x6 and x7? See, when you recognize the revenue, the entry you will be writing is debtor account debit to sales with an amount of 1 lakh. This entry you are passing on 31st of December x6, or let's say on 1st January. Since you are closing on 31st March, so next 3 months you have to recognize interest on this. So 1 lakh into 10% into 3 by 12. So that will be 10,000 into 1 by 4, 2,500. So the entry would be debtor or customer account debit to interest income, finance income. Your ACM approach will, ACM method will be applicable on this financial asset debtor, and this finance income will be recognized in your PRL. Coming to third question. What will be the amount of trade receivable as on 31st March 20x7 against the sale made on 1st October 20x6? Since sale is made on, since sale is debtor is originally recognized at 1 lakh, subsequently income also, interest income also is recognized at 2,500. Debtor ultimately will appear at 1 lakh 2,500. So this one will be your right answer. D bit. Okay, this is in relation to next question. Okay, coming to the second question. On 1st July 20x5, D Limited began an arrangement to sell goods to a third party B Limited. Okay, the price of the goods was set at rupees 100 per unit for all the sales in the 2 years period ending 30th June 20x7. Okay, so the contract period, they have identified it as 1st of July x5 to 30 June x7. However, if sales of the products to B Limited exceed 60,000 units in the 2-year period ending 30th June 20x7, then the selling price of all the units is retrospectively set at rupees 90 per item. It's a very regular question which we normally solve in India is 115, where it's volume based discount. Initially one sale price is fixed, but once your sales cross a particular limit, then the selling price will be reduced, and that reduced price is applicable for the entire lot of sales. So originally it was set at 100. Subsequently, in case in the next 2 years, anytime if you feel that anytime it exceeds 60,000 units sale, in that case per unit the selling price is gonna be only 90 per item. Sale of goods to B Limited in the 9-month period ended on 31st March 20x6 totaled to 20,000 units, and this volume of sales per month was not expected to change before 30th June 20x7, which means correctly understand. He says that the sale happened for 20,000 units for the 9-month period 31st March 20x6. That means even though your contract period is 1st July to 30th June x7, your financial statements are prepared on April model only. So 1st April x5 to 31st March x6. During this 9 months period, you could sell only 20,000 units. So 20,000 units you have sold in a period of 9 months. He says this, so per month on an average 2,222 units you have sold. He says that this per month sale is not going to change in the next year also. So can I say like this, if 20,000 is for 9 months, how much would it be for 12 months? It will be around 26,000 some units. So if in this year I sold 20,000 units, in the next year up to 31st March x7, I sell 26,667 units. Thereafter also another 3 months time is there, April, May, June, another 3 months. So this is what 12 into 3. So it will be 6667. So for this period it will be 6667 units. 26,667 plus 6667. So already you have sold 20,000 units and you are saying that you are going to sell another 33,334 units. So 20 plus 33,000 overall put together, it's 53,000 only. So in the very first financial year in this period, you sold 20,000 units and you believe that during the agreement period, you are not going to sell more than 60,000 units to the customer, and therefore you will recognize revenue in the first year only at the rate of 100 rupees per unit. You definitely collect 100 rupees on every sale, but sometimes you may have to adjust or refund the amount. That case is not going to arise, is what you feel when you are standing at the end of first year. So in the first year, 20,000 units you have sold, and you will recognize you received an amount of 100 rupees per unit, and you will also recognize revenue of 100 rupees per unit, which means that's going to be 20 lakh rupees. It's purely based on estimate that the total number of units sold to the customer will not exceed 60,000 units. So that is about first year. However, in the year ended 31st March x7, the total sale of goods to B Limited were 35,000. You actually estimated that during this period it will be 26,667, but actually you could sell 35,000 units. And based on current orders from the customer B Limited, the estimate was revised. The directors of D Limited estimate that the total sales of goods to B Limited in the 2 years period up to 30th June x7 is gonna be more than 60,000 units. So when I am in second year, I realized that overall sale is going to be is going to cross 60,000. Now that the overall number of units to be sold is going to cross more than 60,000 units, so my revenue per unit is not going to be 100 rupees per unit, it's going to be 90 rupees per unit only. So the question is, how much revenue will you recognize in the second year? So first year revenue, we are not going to change it and all, because that is correctly recognized based on the estimate that we had in the previous year. But as far as the current year is concerned, how much revenue will you recognize? Now if you observe, when I am standing at the end of second year, I would have sold total how many units? First year I sold 20,000 units. Second year I sold another 35,000 units. I have a clarity that the number of units that are going to be sold to this customer is definitely going to cross 60,000 units. So ideally I should recognize revenue of 90 rupees per unit. So this is a cumulative revenue what I should recognize up to the end of 31st March x7. But out of this, I have already recognized in the first year a revenue of 20 lakhs. So if I sort out this, 55,000 units into 90, so that's 49 lakhs 50,000 rupees minus 20 lakh rupees, which is already recognized. So further revenue which you have to book now is 29 lakh 50,000 rupees. So guys, this is the amount of revenue which you will recognize in the second year. See, these are the basic questions, basic analysis. Now actually let's see what he's asking. The first question he's asking is, what will be the amount of revenue to be recognized in the year 20x5 x6 with respect to sales arrangement with B Limited? X5 x6 is the very first year. So in the very first year, the revenue that is going to be recognized is 20 lakhs. So 20 lakhs is which option? A. What will be the amount of revenue to be recognized in the year X6 x7, that is the second year, with respect to sales arrangement with B Limited? So that's going to be 29 lakh 50,000. Fine. Next question. Messrs. XYZ and Co. is an auditing firm. During his audit, the firm is facing difficulty in accounting of the following transaction for which it seeks your answer. So anyway, this first question is based on projected unit credit method of Ind AS 19 employee benefits. If you have idea of how to account for present value of defined benefit obligation, plan assets, or in fact directly you can also account for the net obligation account. So that net obligation account or net obligation statement, if you are having an idea, then this question is a very basic question. So guys, let's read this question and try to parallelly solve it. A Limited has established a defined benefit pension plan. Okay, pension plan, retirement benefit for its eligible employees. The balance sheet of A Limited on 31st March X7 currently includes the estimated net liability at 31st March X6 amounting to 18.75 crores. So the net liability, the word net liability means present value of the obligation liability net of the plan assets that are dedicated for such obligation. The following matters relate to plan for the year ended 31st March X7. The estimated current service cost was advised by the actuary to be 6 crores. So current service cost, the expenditure and the liability improvement in the current year. At the end of the year, A Limited paid contributions of rupees 7 crores into the plan and charged this amount as an operating expense. Contribution paid is treated as a reduction of the net obligation, but this fellow has treated this as operating expense, which is a wrong treatment. The annual market yield on high quality corporate bonds on 1st April 20x6 was 8%. So this is your interest cost measurement. They have given you a rate. The estimated net liability on 31st March X7 was advised by the actuary to be rupees 20.5 crores. No benefits have been paid to the date. Even if there are benefits paid, if the question gives you some benefits paid, that will have no impact on the net obligation. There will be liability decrease, there will be plan assets decrease also. On a net basis, the net impact on the net obligation will be 0. Anyway, that's not given. So anyway, so how to handle this question, let's see. Just for understanding, I'm drawing a net obligation account. You can also draw a statement also. So already we are having a liability of 18.75 at the beginning of the year, and current service cost for the current year is going to be 6 crores. The question has given that amply clear. So by current service cost 6 crores, by interest cost, this is a question did not give you directly. You are supposed to work out this 18.75% into what is the rate given, 8%. 18.75 into the 108. That's going to be 1.5. This is actually the net interest. Interest cost net of expected return on plan assets. So 7 crores contributions have been made. So since the contribution is made at the end of the year, interest cost will still be computed on the opening balance only. So that is not going to trouble you there. Closing liability value, they have given it as 20.5 crores. So now when you balance this account, since you have the opening balance, closing balance, contributions paid on all the expenses, CSC, IC, everything has been recorded. Let's see whether this is tallying or not. 20.5 plus 7 minus 18.75 minus 6 minus 1.5. This is throwing up a difference of 1.25. Since on the net it's a liability, credit side balancing query means we are increasing the liability. So this is a actuarial loss. Actuarial, or you can call it as a remeasurement loss. Now what is the treatment of remeasurement loss? Remeasurement loss will be either debited to PRL or to transferred to PRL or to OCA, depending on whether it is related to a post-employment benefit plan or a long-term benefit plan. In this case, the question is amply clear that this is a pension plan which is a retirement benefit, and therefore this item must be going to your OCA section. This is an actuarial loss, there is no doubt on that. Let's see what questions are asking on this. What is the amount of net adjustment to be made in the statement of P&L for the year X6, X7 with respect to the defined benefit plan? First one, 7 crores added back to the profit of the year X6, X7. Definitely that's not wrong, because contribution should be treated as reduction of liability and not as an expenditure in P&L account. But the question is, what is the amount of net adjustment he is asking? So only 7 crores is one adjustment, but there is interest cost also, there is current service cost in P&L account also. Overall, what is the final adjustment? 6 crores should be deducted from the profit. 6 crores is your current service cost, so that will be deducted, but that's not the net. 0.5 crores deducted, that we will check. 1.5 crores, that has to be, that also will check. Anyway, let's see. In this amount will be debited to PRL. This amount is a debit to PRL. Even this also is a debit to PRL. Nothing else will go to PRL. This will go to P&L account, the second part, which is the OCA section. So if you read the question again, what is the amount of net adjustment to be made in the statement of profit and loss? He is using the word statement of profit and loss. Means ideally speaking, you have to consider PRL section also, OCA section also, both we have to consider, then only we'll call it as statement of P&L. Let us see what answers are or what options are available with us. Now let's see. Current service cost 6 crores is an expense. Interest cost 1.5 crores is also expense. But contribution is not an expense, but they have wrongly treated it as expense. So I have to reverse it. No. So contribution wrongly debited as expense. So I'll remove that. So 6, 1.5 and 7 net put together till here, the effect is coming to 0.5. We can conceptually argue that even 1.25 crores, whatever remeasurement loss is there, that remeasurement loss also is part of statement of P&L account only. Only thing is that will come in OCA section. So if I consider that also, loss only no expense. So overall impact excuse me, overall impact on the P&L account is 1.75 including PRL and OC. Now if you check the options there, you don't have 1.25 there. So 7 is a gross amount, that's wrong. 6 is gross, that also we don't want. We want the net. So you have two answers now, which is 0.5 and 1.5. Now in our answer, if you see, we have 0.5 only after considering the PRL section, without considering the OCA section. So see, that based on the question you have to give our answer. No, so on the options available we don't have 1.75, so they are asking only the PRL section, even though the question actually meant it as statement of profit and loss. The answers available indicate that they are only focusing on PRL part, the first part. So this is going to be our answer now. So 0.45, this will be my answer here. Next, what is the amount of actual gain or loss on the defined benefit pension plan? Defined benefit actually just now we got 1.25 crore, but it would have been nice had they mentioned it as loss. Next, anyway, another question. On 1st April 2xx0, E Limited completed the construction of a non-current asset with an estimated useful life of 20 years. Okay. The cost of construction recognized as property, plant and equipment and depreciated appropriately. That's also nice. E Limited has a legal obligation to restore the site on which non-current asset is located on 31st March 20x20. So apparently must understand that this is the date of construction or when the asset becomes ready for usage, and since it has a life of 20 years, after 20 years you are going to have a decommissioning obligation on you. The estimated cost of this restoration work is gonna be 2.5 crores, but 2.5 crores is not as on today, but this is at future date ka cash outflow. The directors of E Limited have made a provision of 0.125 crores. How did they get 0.125 crores? At 2.5 crores, they are amortizing it to 20 years, and each year they want to create provision of 0.125, 0.125, 0.125 like that for 20 years, so that it will eventually become 2.5 crores, which is obviously a wrong treatment. An appropriate annual discounting rate to use in any calculations is 6%, and the PV factor for 20 years is 0.312. So guys, it's a pretty basic point that when you have a decommissioning and restoration obligation, all you have to do is estimate the amount of expenditure you are going to incur in future, discount that to today, create a provision, but don't debit it to P&L account, but you have to debit it to the cost of the PPE itself. And since the liability is created at present value, like how you do in ACM approach of Ind AS 109, on this liability every year you have to do unwinding of discount. But this fellow did not do that. Not only he did not do that, he wrongly created some provision in P&L account which is based on straight line method, which is wrong. So let us see how did basic calculations. Let's try. So present value of decommissioning costs, decommissioning or restoration cost is equal to, you are expecting at 2.5 crores into PVIF 6% for 20 years, which is given as 0.312 into 0.312. So 2.50 into 0.312. So that is equal to 0.78 crores. So ideally on the very first day, PPE account debit to provision for decommissioning and restoration. This provision you should have created by debiting your asset basically, but this entry that fellow did not write. Okay, and you are closing at the end of the year, I guess 31st March X1. Okay, so when you are standing after 1 year, prima facie your financial statements are wrong. Had you recorded this entry on this provision, you would have to also recognize interest cost also. So interest cost on decommissioning liability is equal to 0.78 into 6%, 0.0468, 2.5 into 0.78 into 6%, 10468, correct. Next thing, had you capitalized the 0.78 to the PPE, you would have also depreciated the PPE by a little higher amount. So depreciation on PPE for the year. So 0.78 into, what's the life of the asset given? 20 years. No, sorry, into 1 by 20. So depreciation would have been 0.78 divided by 20. So it's 0.039. Seema, this is also an expenditure in P&L account. This is also an expenditure in P&L account. These two expenses are not recognized. Rather, expenditure or provision wrongly created. (0.125). I wanted this 0.039 plus 0.0468. I wanted 0.0858 expenditure. This is what is desired impact, but this is what you did wrongly. Let's see what questions are being tested on this. What is the original provision required to be made on account of restoration of non-current asset in future? So original provision is 0.78, which is present value, this one. What will be the amount of adjustment to be made in the retained earnings on account of restoration provision? Okay, so because you have messed up this entire calculation and you did not do what you are supposed to do, what impact will it have on the retained earnings? Indirectly on the P&L account of the current year. See, we would have desired this expenditure. Desired expenditure. The expenditure charged wrongly to P&L. So you have overcharged basically. So some amount, effectively if you see, the profit will now increase. So by how much? The gap 0.085 minus 0.125. So it will be 0.0392. This is extra, or rather I'll say increase in the profit of current year after rectification. So if you have 0.0392 in your answer, you should tick it. What will be the amount of 1 year's unwinding of discount on account of restoration provision? Very cheap. He's asking interest cost 0.0468. So there you go, sir. So these are your questions up to now. Okay, coming to income taxes. Next question. The next question, income taxes question. This is purely based on tax-based concept. Tax-based, that too of an asset. So before we go there, one small recap. Tax base of an asset. When future economic benefits are taxable, then tax base will be equal to future deductions that will be available under tax laws. In future, what deductions are we likely to get? The entire total deduction in respect of that asset which you are likely to get in future, that entire amount must be treated as tax based today. In case, if future economic benefits are not taxable, then tax base will be equal to carrying amount. And when tax base and carrying amount both are same, the effective DTA DTL will be 0. The question does not go into requirements of whether we should create a DTA or DTL. So that part of the discussion we are not going to do. They're simply asking tax base. Anyway, if you want DTA DTL also, you have this regular formula. No, sir, everybody must be aware of this, where CA carrying amount minus tax base, you take the difference. On that you apply the tax rate. Whatever answer comes, that will be either a DTA amount or DTL amount in the balance sheet. Since we are talking about an asset, if the number is positive, the answer is DTL. If the number is negative, the answer is DTA. Carrying amount indicates future economic benefits. Tax base talks about future deductions. So if the net amount is positive, it indicates that in future you are going to have net taxable income and therefore you have to pay tax in future. So today you should have a DTL. On the other case, if it is negative, what it means is your deductions in future, that is tax base is higher. That's the reason you'll get a negative amount, right? So if you have a negative amount there on the net basis, it means that there are more deductions in future than the taxable income. So in future, you are going to make tax savings. So today you should have a DTA. So that's pretty much about the concept there. Anyway, let's see. X Limited, an Indian company, owns a freehold land with carrying value of rupees 10 lakhs, which is not depreciated for tax purposes, but is indexed for inflation. Land now, so no depreciation. But in case you sell it and all, indexation benefit is given. And standing today, indexed value and fair value of such land is 15 lakhs and 22 lakhs respectively as of the reporting date. So for income tax purposes, indexation benefit will be given to you on the land, in which case they'll give you 15 lakh deduction in case you sell the land. And the fair value of the land today is 22 lakhs. Excuse me. What will be the tax base for such freehold land for measurement of deferred tax if? So the question is, what will be the tax base for such land? That's all. First one, X Limited intends to sell it as a part of slum sale of the business eventually after using it for business purpose. So some days you are going to use this land for your business and eventually you are going to sell it. Before you answer this, one more point is there. Turn back. He says that as per the applicable tax laws in the jurisdiction, indexation benefit is not available if the freehold land is sold as a part of slum sale of the business, but indexation benefit is available if freehold land is sold individually. What is he saying? If you sell the land independently on its own, then you are not going to get any benefit. Then you are going to get indexation benefit. But if you sell this land as a part of so many other assets and liabilities without assigning individual values, which you call it as slum sale under Income Tax Act, in that case, indexation benefit will not be given. So how much reduction will you get in future under income tax depends on whether you are likely to sell the land individually or you are going to sell the land as a part of so many other assets and liabilities. So accordingly, our tax base also will change. So let's see. First scenario, X Limited. See, you must understand this. The only formula that's applicable for you now is this one. Tax base is equal to future deductions under income tax law. So let's see first one. X Limited intends to sell it as a part of slum sale of the business eventually after using it for business purpose. Since you are going to sell it as a part of slum sale, you are not going to get indexation benefit. So how much reduction they will give you? Only 10 lakh rupees without indexation. So tax base in the first case is going to be 10 lakhs. X Limited intends to sell the land individually and not on a slum sale basis. So since you are not going to sell it on slum sale basis, you will sell the land individually. Indexation benefit is available to you, and in that case your future deduction will be 15 lakh rupees. So your tax base is 15 lakhs. Next one. X Limited has classified such land as investment property and intends to sell it individually and not on slum sale basis. Fine. Even if you call it as investment property also, how does it matter for us? Since you are going to sell it individually, the deduction you are going to get is 15 lakh rupees. X Limited follows revaluation model for freehold land. Follow whatever model you want and intends to sell it individually. What I want is, what are you going to do with the land? Will you sell it individually or are you going to sell it on slum sale basis? Since this fellow is also going to sell it on individual basis even in the fourth scenario also. So here also your tax base is going to be 15 lakhs only. Sir, what impact will it be there if he is following revaluation model? Sir, if you are following revaluation model, your carrying amount will not be cost, your carrying amount will be fair value. Since your carrying amount will be fair value, when I do CA minus TB into tax rate, you will have a DTA or a DTL which will be accounted via OCA section because there is a revaluation profit involved in that. That's it. But the question is not on DTA detail, the question is only limited only up to the tax base part. So we worry only about the tax base part of it. So answer is 10 for first case, 15, 15, 15. Okay, next one. This is a question based on leases. This has also been tested in previous RTP as well. So nothing new concept, very basic level concept. So the question is based on leases, whether, see, if the contract is or contains a lease, depends on whether you are having an identified asset or not. Of course, other conditions are also there, like you should have an enforceable lease term, you should have a right to control the usage of the asset and all that is fine, but this question is specifically based on identified asset. Now, before we read that question down there or the case down there, identified asset concept says that the asset must be physically distinct. Means you should be able to identify which part of the asset is yours or which capacity of the asset is yours, that you must be able to clearly demarcate. The only exception is if you see, so the basic rule is if you are unable to identify or the contract does not mention which part of the asset belongs to you, the customer, for lease purposes, then there is no identified asset. So there is no identified asset if the asset is not physically distinct. However, if you have contracted to obtain all or substantially all of the capacity of the asset, in that case, even if the asset is not physically identified, but still, since you have contracted all or substantially all of the capacity, identified asset exists. So asset must be physically distinct, first condition. Next one, there should be no substantive substitution rights of supplier. So the owner of the asset, he should not have any realistic chance of taking the asset back and replacing it with another asset. So whether it is substantive or not, how will I know? So for that, the standard says there are 2 points. If both the points are cumulatively satisfied, then the rights are substantive. So what are the 2 points we have? One is the supplier has economic benefit if he substitutes the asset given to you with another asset, plus he has the ability to substitute. So I can hit you, I am quite strong and I am also very angry on you. So the chance of me hitting you is very high. So if the chance has to be high, first of all, there should be an intention to hurt you. Okay, then I should be capable of hurting you. Similarly, the asset what you have taken it on lease, if that supplier is going to substitute or not depends on, by substituting, is he going to have some benefit and is he having the capacity to substitute the asset? These 2 things you have to see. If these 2 points are satisfied, then we will say that the substitution rates are substantive, and therefore there is no identifiable asset. Sir, I am a customer who took the asset for usage purposes. How will I know whether he is going to have economic benefit or not, whether he is going to have the ability to substitute or not? For that, India's 116 says you need not make any inquiries and all. You apply reasonable efforts. If you are unable to come to any conclusion, believe that substitution rights are not substantive and therefore identified asset exists. So anyway, let's see. Case 1. Excuse me. Scenario 1. The last mile is a dedicated cable that connects entity Y's network with end customer's device. The use of this cable is at the discretion of the customer. Entity Y decides the location of the endpoints and has right to replace the lines. However, it is not practical to replace the line since replacement would require additional cost to be incurred without any corresponding benefit. So the supplier entity Y is having a right to replace your asset. They have a right to substitute your asset. But he says that it is not practical. Reason, the costs incurred for replacement won't justify the benefits that they are going to get because of the replacement. Whether the arrangement would be within the scope of India's 116. So what is the answer we should write? Out of these 2 points, economic benefits and ability to substitute, it's very clearly that the substitution rights are not substantive. Means the chance of the supplier replacing the asset with another asset is very, very less. Since this is not substantive, therefore identified asset exists. If there is an identified asset, presuming that other conditions are also satisfied, like the right to control the use of identified asset, an enforceable lease period and all, then definitely this is under the scope of India's 116. Excuse me. Scenario 2. If it is practical for the entity Y to replace the lines and entity Y would benefit from this replacement, would the answer be different? What is he asking now? If these two conditions are satisfied, benefit is also there to the supplier. He has having the ability also to substitute this asset with another asset. In that case, do you have an identified asset? The answer is no, because the substitution right of the supplier is very substantive. Since it is substantive, he is very highly likely to replace the asset he has given to us. When the asset is going to be taken away and substituted by another asset, in that case, how can I say that I have an identified asset and with what face will I capitalize ROU asset and all? Definitely there is no identified asset. So in the second case, no identified asset. Coming to case 2. Customer X enters into a 10-year contract with a utility company, entity Y, for the right to use 3 specified physically distinct fibers within a larger cable connecting Mumbai to Delhi. So in the fibers, which cables belong to you, you have identified 3 specified physically distinct. So physically distinct point is satisfied. Customer makes the decisions about the use of the fibers by connecting each end of the fibers to the electronic equipment. So how to use, where to use, when to use, all these decisions, that is right to control the use, is there with the customer only. Entity Y, that's a supplier, owns extra fibers but can substitute those for customers' fibers only for reasons of repairs, maintenance or malfunction. So substitution can happen, that's only because, not because it will benefit the supplier, because the item is damaged or for repair purpose and all like that. In that kind of situations, obviously he will replace it or repair it. That is not a violation of substitution right concept and all. The useful life of the fiber is 15 years, out of which you have agreed to take it for 10 years period. Whether this arrangement is covered under Ind AS 116, yes. So since the asset is physically distinct, we can say that identified asset exists. And since the question very clearly says that right to the decision making is there with the customer, so we have a right to control the usage also. Definitely it is covered under Ind AS 116. Both the points are satisfied. Next, customer X enters into a 10-year contract with entity Y for the right to use a specified amount of capacity within a cable connecting Mumbai to Delhi. Now you observe this time, specified amount of capacity. Let's say you have agreed that I want 30% of this entire cable. So entire capacity is 100%. I need to take only 30%, 40% like that. Some percentage you have specified capacity. The specified amount is equivalent to customer X having the use of full capacity of 3 fiber strands within the cable, but the cable contains multiple fibers with similar capacities. So there are so many cables. Out of that so many cables, you have obtained a right to use a certain capacity which is equivalent to the capacity of 3 cables, but which 3 cables is not specified. So apparently what happened, this is not physically distinct. When the asset what you have taken on lease is not physically distinct, prima facie there is no identified asset unless you have obtained to use the entire capacity of the asset, which is not sounding like it. Entity Y makes decisions about the transmission of the data. Okay. Entity Y lights the fibers, make decisions about which fibers are used to transmit customer traffic. That means the asset, which asset is to be used, decision making is there with the supplier and not with the customer. The life of the fiber is 15 years. Whether this arrangement is covered under Ind AS 116, the answer is no. So the answer is no. Here the answer is yes. Why no? First of all, this is not physically distinct. Second thing, decision making rights are also not there with the customer, they are there with the supplier. So right to control also is not there. Prima facie identified asset is not there. So there is no lease agreement in accordance with Ind AS 116. Next. This is a very simple question, sir. See, if you have to, excuse me. Okay, coming on to this concept, Ind AS 41. See, if the activity what you are doing, if it has to be covered under the scope of Ind AS 41, prima facie it should be an agricultural activity. So when will be it? When will your activity be called as an agricultural activity? Is when the entity is involved in the management of biological transformation of biological assets. So Biological transformation. Every living being goes through the phases of growth, degeneration, procreation, and production. Growth, size growth, degeneration, size reduction, plant, animal, cow, anything. Production, milk, fruits, and all. Procreation is giving birth to new life, like cow giving birth to calf. These four processes are called as biological transformation. Our entity should be involved in the management of biological transformation of biological assets. Sir, with what intention? For sale. See, agricultural produce comes, which you sell it, or for the purpose of harvest, that is harvest and agricultural produce, or some entities are involved in animal husbandry. They create more animals and they sell it. So either for sale or for further usage. The objective is, so the main principle is you should be involved yourself in the management of biological transformation of biological assets. Then only it is called as an agricultural activity. Let's see the first case. ABC Limited is in the business of manufacturing an apple beverage and requires large quantity of apples to manufacture such beverage. In order to satisfy its requirement of apples, it enters into 3-year lease contract with the owners of apple orchards. The lease contracts are mainly of two types. Number one, the owner of the apple orchard. So apple orchard ka owner raises the apple trees to produce apples. Okay, ABC Limited, that is our entity, which is lessee, makes a fixed annual payment to the owner of the apple orchard, who is required to cultivate the produce as per the specs of ABC Limited. Okay, ABC Limited harvests the apple itself for fulfilling its requirement of the apples. So what is the contract here? That our company ABC Limited will not grow the trees, will not take care of the biological transformation and all. We'll simply tell how much apples we want and at what time we want, and the owner of the apple land, that fellow is going to raise the trees accordingly. Ultimately, when the apples are ripe and ready for plucking, our people will go and just harvest them. So we are simply plucking out the apple from the tree by making a fixed payment after giving detailed specifications of how much quantity of apple we want and all. But where are you involved? Where is our entity ABC Limited involved in management of the biological transformation of the asset? So since we are not engaged or we are not involved in the biological transformation of biological asset, therefore there is no agricultural activity. Next one. Contract 2. ABC Limited obtains apple orchard from the owner. So we take the entire land to raise apple trees. So we will only raise the apple trees for subsequent harvest of the apples to ensure that apples are as per the requirements of ABC Limited. So this sounds like a very clear-cut case of an agricultural activity, because you are simply taking the land, and on that land you yourself will grow the apples or grow the trees, and from that apples will come out. That apples you are going to harvest it. ABC Limited makes a fixed annual payment to the owner of the apple orchard. Of course, for the land what you have taken, we pay the lease rent. Whether ABC Limited is engaged in agricultural activity, the answer is yes in this case. Okay, this is a question based on events occurring after reporting period. So this is pretty basic level. It's a change in estimate of useful life of the asset and non-adjusting events. You can go through it. It's a very simple sum. Okay, coming on to 15th question. This question has not come in the past anywhere, so we can go through this. At 31st March 20X1, the assets of CGU are being reviewed for impairment. So why are they being reviewed? Indicator is there. The carrying value of CGU's net assets is 65 lakhs, excluding any restructuring provision. Okay, and remaining useful life of the recognized asset is 8 years. So still it has a life of 8 more years. Management's approved budgets at 31st March 20X1 include restructuring cost of 3,50,000 to be incurred in 20X2. Okay, the restructuring is expected to generate cost savings of rupees 1 lakh per annum from X3 and onwards. Okay, so in your budgets you have approved that you are going to incur some restructuring expenditure in future. If you incur that expenditure in future, you are going to get more additional cost savings. Okay, so future benefits exist. Formal budgets have been prepared for the 3 years to 31st March X4. A zero growth rate is assumed because market conditions are extremely competitive and this is expected to continue for the foreseeable future. The future cash flow estimates are as follows. What is that zero growth rate and all? We are saying no. When you incur 3,50,000 and from that next year onwards, you are going to get 1 lakh rupees extra savings over a period of remaining 8 years or 7 years, whatever period is there. Every year the incremental earning is going to be only 1 lakh. That is not going to grow because the market is very competitive. Fine, all that is okay. The future cash flow estimates are as follows. So they have given you with restructuring, without restructuring cash flows. So your future cash flows with restructuring, without restructuring. If you do not restructure, your cash flows are going to be like this. If you restructure, your cash flows are going to be like this. As you can see, okay, anyway, he'll explain. In 2000X2, the net cash flows without restructuring, under this one, 870,000, exceed the net cash flows with restructuring, 5,20,000, by the amount of restructuring cost, 350,000. So what he is saying is the delta between 870 and 520, the 3,50,000, that's nothing but the amount what we have estimated for restructuring cost to be incurred in the first year. So when I am talking about the first column, this column, when I am talking about this column, I am talking about incurring the restructuring expenditure. No. So in the next year, there will be a cash outflow. Because of that, net cash inflow will decrease. But year on year, my cash inflow will be higher by 1 lakh compared to the adjacent column. If you do not go for restructuring at all, in that case, your cash inflow normally will be 8,70,000, and hereafter your normal cash flows will be there, which will be lower by 1 lakh when you compare here and here. The future cash flows, which exclude inflation, have been discounted at the rate of 4%. So 4% is the PV factor what you have to apply. For simplicity, it has been assumed that the cash flows, all the cash flows arise at the end of the year. Fine. He's asking compute the impairment loss. Anyway, let's read that question in a while, what the requirement of the question, but let's go through a small concept. See, sir, in your balance sheet, you are having an asset. Some carrying amount is there. The asset in its current condition is capable of giving you some cash flows in future. Ideally, for testing impairment, recoverable amount we have to compute. Recoverable amount is higher of FEL, CTS and value in use. And while determining value in use, you must always consider the future cash flows arising from the current condition of the asset. So, if the asset is used like this only in its existing conditions, then what cash inflows will I get? Only that much you have to consider. Sir, but I have serious plans of changing the way in which the asset is going to be used, or I have plans of making some extra alterations to the asset because of which my future cash flows is going to improve. Sometimes life also improves. Should I not consider all of that plans, sir? See, the standard status is like this. Any restructuring cost or the impacts of your future restructuring can be incorporated into value in use calculation. That means improved cash flows can be considered, provided you are committed to the activity of restructuring. What is the meaning of committed here? Committed in the sense you kind of already in negotiations with some third party to get alterations to your asset, or you have already paid some advance, or you are so committed that you even created a provision for restructuring, because restructuring is of two types, because one is you making some alterations to the assets and all. The other one is the way of utilizing the asset also can change. Suppose you are removing few employees, you are going for fully automated machine. In that case, those employees whom you are removing, the lease contracts what you are terminating, for all that you have to pay some penalties and damages. For that you have to create a provision. So how committed you are? If you are really committed for restructuring, then we can take the impact of restructuring into your future cash flows. If you are not committed, then don't take. So basically this is a provision of Ind AS 36. So in this background, let's see. He's asking compute impairment loss on 31st March X1 when restructuring cost is recognized in the financial statements at 31st March 20X1. So what he is trying to tell you is, you have your asset. He said that asset is recognized at what value? Asset book value, carrying amount he has given already 65 lakhs, correct. See, asset is already appearing at an amount of 65 lakhs. And you already created a provision for restructuring. Now, go back and think, when will I create a provision? If you go to your Ind AS 37 and see, you will create a restructuring provision only when there is a obligation for you to incur that cost. That can be a legal obligation or it can be a constructive obligation. And a constructive obligation can lead to a provision for restructuring if and only if the entity has a detailed plan of restructuring and the entity has already implemented the plan or started to implement the plan or announced the plan to all the affected parties. Then only you can create a provision for restructuring. If the question tells you that you have created a provision for restructuring, what it means? The entity is committed to implement the plan. So since the entity is committed to implement the plan, you have to do value in use calculation, that is recoverable amount determination by considering cash flows with restructuring impact. So the first column cash flows must be considered. So what you basically will do is, whatever first column, that 520, 10 lakhs, 10 lakh 50,000, E column is there, all that cash flows, discount it with the appropriate given rate. Some number will come, that is that you accept it as recoverable amount because FELCTS is not there with you. So that's the recoverable amount, and that you have to compare it with the carrying amount. Now, when you talk about carrying amount, you must be careful to determine the net carrying amount, because this liability is directly related to that asset. So net carrying amount of the asset is 65 lakhs minus 350, that will be 61 lakh 50,000. So I'll quickly show you the answer down there. See, first scenario, he has considered the impact with restructuring. He discounted everything. The present value came to 65 lakh 14,000, which is calling it as value in use, which will be your recoverable amount. This you have to compare it with. Your existing carrying amount. But your asset is not alone. No, asset has a wife also now, which is restructuring provision. So net amount, which is 61 lakh 50,000. With that, you have to compare. So 61 lakh 50,000 is the carrying amount, and recoverable amount is how much? 65 lakh 14,000. So impairment loss will exist for you only when CA exceeds RA. If your carrying amount is more than the recoverable amount, that means if you are fat, then only impairment loss will be there. You are not fat, the net carrying amount is lower than the recoverable amount, so there is no impairment loss in the first scenario. Okay, second scenario answer also we will discuss it off. Second scenario, he says that the entity did not create any provision for restructuring. Since the entity did not create any provision for restructuring, it means that the entity is not yet committed to the plan of restructuring. Since the entity is not committed to the plan of restructuring, the asset will be considered in its existing condition only, ignoring any impacts of restructuring, right? So the carrying amount of the asset now is going to be 65 lakhs. For in the books also it will be 65 lakhs. For impairment testing also you will consider the gross carrying amount of the asset, which is 65 lakhs. So restructure provision is not created. Now coming to the recoverable amount part, which is value in use in this case, the second column of the cash flows, you take discount everything to today. So if you do that, you are having 62 lakh 73,000. So that 62 lakh 73,000 is a value in use, whereas your carrying amount is 65 lakhs. So 65 lakhs versus 6273, definitely you will have a impairment loss, which is 2 lakh 27,000. It is like that. This question has not come in the past anywhere, but this is a pretty basic concept. Simple done question, nothing very difficult or complicated. Okay, what next? Coming to intangible assets question. Okay, this is a very easy question actually. SS Limited has the following transactions during the financial year X1, X2. On 1st April 20X1, SS Limited purchased the net assets of M Limited for 13 lakh 20,000. Okay, so PC paid is 13 lakh 20,000. The fair value of M Limited's identifiable net assets on that date was 10 lakhs. So fair value of identifiable net assets is 10 lakhs. So this is goodwill calculation. So you paid extra 3,20,000. So 3,20,000 should be identified as goodwill. What else? The SS Limited is of the view that due to popularity of M Limited's product, the life of the goodwill is 10 years. So what they believe is, we paid extra consideration 3,20,000. The extra consideration ka benefit we are going to enjoy over a period of next 10 years. Now you see, unlike your normal accounting standards, here we don't have anything called as amortization of goodwill. Goodwill is an intangible asset which is subject to continuous impairment testing each year. So there is no concept of amortization of goodwill. So whatever data they have given regarding the life of the goodwill and all that is irrelevant for you. So just understand that from the first point, there is a goodwill intangible asset of 3,20,000 and there won't be any amortization of goodwill. There will be only impairment testing of goodwill. On 4th May 20X1, which is also in the current year only, SS Limited purchased a franchisee to organize musical shows from ATV for 80 lakhs and at an annual fees of 2% of musical shows revenue. So we purchased a franchisee. Franchisee is an intangible asset. So the cost what we paid is 80 lakh rupees for it. So this is a cost. And also the initial recognition amount. But not only this, whenever such a show we conduct in reality, whatever fees comes, in that fees again you have to pay another 2% also. Okay, the franchisee expires after 5 years. The musical shows revenues were 10 lakh rupees for the year ended X1, X2. So for the current year, the revenue for year 1, the revenue for year 1 is 10 lakh rupees. Since the revenue for the current year is 10 lakhs into 2%, you have to pay as fees, no? So that is going to be 20,000 rupees. Fees you have to pay. And for the remaining 4 years, the revenues are given like this. Year 2 revenue is going to be 25 lakhs. And for the remaining 3 years, it's going to be 30 lakhs per annum. Okay. So anyway, why is he giving you, sir, revenue of so many years and all? Now you see, he's trying to tempt you by making you compute amortization based on revenue. It's very, very clearly stated in India's 38 that you are not supposed to use revenue as the basis for amortization of intangible asset unless such a revenue itself is a limiting factor. Limiting factor means how much benefit you will extract from the asset is linked to your revenue. So this is not that case, no. So how much benefit I will get is how many tickets I am able to sell, how much money I am going to get. The benefits is not limited by the amount of revenue I am going to get. So revenue is not the limiting factor. So revenue should not be considered as a tool for amortization. So what's the life of the franchisee given here? The life of the franchisee is given as 5 years. So 80 lakh rupees divided by 5 years, that's your amortization. Of course, you purchased it during the year, maybe monthly adjustment you might have to do. Let's see. On 4th July 20X1, that's also in the current year only, SS Limited was granted a copyright that had applied by M Limited. So we got a copyright which is also applied by some other entity as well. During the year X1, X2, SS Limited incurred 2,50,000 on legal cost to register the patent. See, the cost of registering the patent is part of the cost of intangible assets. So this 2,50,000 rupees, it will be capitalized. And rupees 7 lakhs additional cost to successfully prosecute a copyright infringement suit against a competitor. Since M Limited also applied, M Limited is a company which we have taken over. There is a competitor. That competitor is saying that we have infringed his patent and all. In that case, we went for a legal fight. In the process of this legal fight, we incurred some cost. So this legal cost has got nothing to do with the cost that is capitalized to the cost of the asset. So this one is something which will book it in PRL as an expense. So SS Limited follows an accounting policy to amortize all intangibles on straight line basis or any appropriate basis over a maximum period permitted by relevant Ind AS, taking a full year amortization in the year of acquisition. So even though you have acquired it in the year, during the year also, full amortization you have to provide. So month-wise adjustment is not required for your amortizations. So here what is the mistakes you are capable of doing is goodwill amortization, some data he has given, don't touch that. That franchisee what you have bought, that relating to that franchisee, what revenues are you going to earn in future, that data is also given. That data also is irrelevant for you because revenue based amortization is not allowed. So first goodwill, that will not be amortized. Second one will be depreciated. In fact, I'll do it right now. 80 lakh rupees divided by 5 years. So how much is that? 16 lakhs. So per annum. This is the amortization. Coming to this patent, the life of the copyright is 10 years. So you have acquired it in the year, current year. So 2,50,000 is the cost. 10 years means 25,000 rupees is your amortization. So effectively it will be 2,25,000 is the net carrying amount closing at the end of the year. Whereas this asset carrying amount, the first asset carrying amount will be 80 lakhs, 16 lakhs you provided. So remaining will be 64 lakh rupees. Goodwill you will not touch because there is no amortization for goodwill. He's asking, you are required to prepare a schedule showing the intangible section SS Limited balance sheet as on 31st March X2. So intangible asset ka note he is asking. So we have three intangible assets now. One is this franchisee, 64 lakhs ultimately, 225,000 for your copyright and 3,20,000 for your goodwill. That's okay. And a schedule showing the related expenses that would appear in the statement of P&L account of SS Limited for the year ended 20X1 X2. So P&L account lo what will appear? That too only related to expense. So your current year revenue 10 lakhs that you need not show. Only expenses part ka extract he is asking. So what P&L impacts will be there? Regarding goodwill, there is no impact of P&L account expenditure. But regarding to franchisee, there will be depreciation of 16 lakhs. Not only that, your first year revenue, since you earned 10 lakhs, on that 2% you have to pay to that fellow also. So the 20,000 rupees fees also you have to consider in P&L account. So 16 lakhs depreciation, 20,000 fees. And regarding this copyright, your depreciation amount is 25,000, but this 7 lakhs also will go to P&L account. So all these yellow numbers will go to your P&L account. 20,000, 16 lakh rupees, 25,000 and 7 lakh rupees prosecution fees. So that's it, sir. Let's check the solution. 16th question. So as you can see here, goodwill 3,20,000, the same number what we computed. Franchisee originally recognized at 80 lakhs. On that you provided depreciation of 16 lakhs or amortization of 16 lakhs. So closing is 64 lakhs. Copyright initially capitalized at 250, 25,000 rupees amortization, 2,25,000 closing balance. So total intangible asset is 69,45,000. And regarding your P&L account, revenue he has given, though they did not ask that specifically. Expenses part 16,25,000 and 7,20,000. 16,25,000 is 16 lakhs depreciation amortization on franchisee, 25,000 on the copyright, 7 lakhs is your legal expenses, 20,000 rupees is your fees paid on the revenues earned. That's all. And then he has given an extract of balance sheet. They have given it as like this: intangible assets total 69,45,000, but as such if you see schedule 3, this should be goodwill separately 3,20,000. So out of 69,45,000 I am removing 3,20,000, so that will be 66,25,000. This will be called as intangible assets other than goodwill. So in the ICA answer, they clubbed all the intangible assets. They have given it as a single number, but as such, schedule 3 presentation on the face of the balance sheet, and also India's one requirement is goodwill show separately, other intangible assets show separately. Of course, goodwill is also an intangible asset, but nevertheless, it has to be shown separately. Okay, answer they have clubbed it, and that's okay. So small mistake that happens. Let's see who's the next question. Who are you? Okay, simple question. On 1st October 20X1, XY Limited completed the construction of a power generating facility. So 1st October is the date on which construction got completed already. The total construction cost was 2 crores. The facility was capable of being used from 1st October X1, but XY Limited did not bring the facility into use until 1st January X2. See, for depreciation calculation purposes and all, when you actually put to use is irrelevant. When the asset is ready for use, immediately depreciation commences. So that date in our question is 1st October. So actual date of usage is irrelevant for us. That's the reason the estimated life of the facility at 1st October 20X1 was 40 years. So they gave you life only from the date when you are supposed to compute depreciation. Under legal regulations in the jurisdiction in which XY Limited operates, there are no requirements to restore the land on which power generating facilities stand to its original state at the end of life of the facility. So we don't have any legal obligation to remove the decommissioning obligation. Legally is not there. However, our company has a reputation for conducting its business in an environmentally friendly way and has previously chosen to restore similar land even in the absence of such legal requirements. So for reputation's sake, we have restored some lands in the past similarly, and this existing land also we are going to restore. This is called as what, sir? In the terms of India's 37, this is called as a constructive obligation. For creating a provision, present obligation is required. That obligation can be legal obligation also okay, constructive obligation also okay. So here it's a case of a constructive obligation. The directors of XY Limited estimated that the cost of restoring the land in 40 years time would be 1 crore. Okay, so after 40 years you are likely to incur 1 crore rupees. The annual discounting rate to use in any discounting calculation is 5%, and the PV factor they have given it as 0.142. So 1 crore into 0.142, if you multiply, that will be 0.142 crores. Explain and show how the above event would be reported in the financial statements of XY Limited for the year ended 31st March X1. Ignore comments on potential future reclassification issues. Fine. So what he is saying is, 1.142 crores ka accounting, how will you do? So what is the cost of the PPE given? Cost of the PPE is 2 crores. So your capitalization amount is going to be 2 crores. Let me get full amount, 200 lakhs. This is the original cost of the asset plus PV of decommissioning liability, that is 100 lakhs into 0.142. 0.142, so that's coming to 14 lakh 20,000. So 214 20,000. This is the total amount which you have to capitalize as the cost of the asset. Now after capitalizing this much amount, what impact, what is the question exactly? How the above events will be reported for the year ended 31st March X1. Okay, so all this amount you have to capitalize on 1st of October. Since you are closing on 31st of March, for the next 6 months you have to provide depreciation on this. So depreciation for 6 months, 214 lakh 20,000 into 1 by 40, because life is 40 years. And since in the current period we are going to use it only for a period of 6 months, so that's gonna be 267,750. So 267,750 is your depreciation for the current year. So carrying amount of PP on 31st March 20x2 is equal to 211 lakhs 52,250. Right. This is regarding the asset carrying amount at the end of the year. Now coming to the provision balance. Decommissioning provision. Initially you recognized at 14,20,000, and on this 14,20,000 you have to do unwinding of discount, or that is nothing but interest cost ka recognition expenditure. So 14,20,000 into what's the discounting rate given? 5%. So that into 5%, this will give you per annum. In the current year only 6 months period only is there. So till we close our accounts, 14,20,000 into 5% divided by 2, 35,500 plus 14,20,000. So that's coming to 14,55,500 rupees. So this will be your decommissioning provision by the end of the year. That's all. What else will you do? It's just a very, very straightforward, simple question. Okay, come to next one, sir, quickly. Coming to borrowing cost question. X Limited commenced the construction of a plant which is a qualifying asset on 1st September 2021, estimated to a cost of 10 crores. So we started constructing a power plant on 1st September. For this purpose, X Limited has not raised any specific borrowings. Rather, it intends to use general borrowings which have a weighted average cost of 11%. Total borrowing cost incurred during the period from 1st September 2021 to 31st March X2 were 0.5 crores. So the actual borrowing cost what you incurred is 0.5 crores. So your construction commenced on 1st September 2021, since you are closing on 31st March X2. So from 1st September to 31st March X2 is the period during which borrowing costs can be capitalized. And the actual borrowing cost what you have incurred is 0.5 crores. So they have given each month how much costs are spent. So in fact, September, October till like that up to March. And cost of construction accrued is given and cash outflows is also given. Now what is the difference between cost of construction accrued and cash outflows paid? Accrued means what? You have taken the benefit, whether paid or not, that's irrelevant. So we consumed the benefit of a particular service or goods. Amount paid or not is irrelevant. So accrual concept of one statement they made. Each month ka expenses. Then cash outflow ka statement they made. So they need not coincide. No, I might pay in advance right now. Next 3 months I'll be consuming over a period of time, or I'll first consume, later on I will pay. So consumption of services or goods from the other parties and payment to them need not coincide, right? So the first column is about accrued basically expenses. The second column is when you actually paid them. What is the amount of interest that should be capitalized to the cost of the plant in the financial statements for the year ended 31st March 2022? So he's asking how much borrowing cost should I capitalize? See, your weighted average cost of borrowing rate is given. So your capitalization rate is going to be 11%. The question is 11% you have to apply on which amount? So normally what we do when expenditures are incurred on multiple dates. So what we'll do is we'll first work out a weighted average expenditure incurred during the year. So okay, average amount will work out. For example, 1.5 crores is there. This is invested in the project, or this is used in the project for a period of 7 months. September, October, November, December, January, February, March. So 7 months. So up to 7 months used. Similarly, this 0.5 you are using it only for a period of 6 months. This you are using it for a period of 5 months. Like that. If you completely average it, one single number will come. On that single number, you have to apply 11%. That's your final answer basically. But the question is, which one will you consider for doing that weighted average expenditure? The expenditure on which capitalization rate has to be applied. Now that expenditure, how will you compute? Based on cost incurred, based on cash outflows paid. Because they both need not coincide. No, so it's a very conceptual question. So if you look at see, normally between these two, the gap will not be usually significant. But in this sum, if you work out the weighted average capital expenditure on both the cases, there is going to be a significant difference. See here. 1.5 crores into 7 by 12, 0.5 into 6 by 12, 1.5 into 5 by 12, like that. based on when you have incurred till 31st March, they worked out a weighted average expenditure that came to 2.74. Similarly, based on how much you spent, not incurred, how much cash outflows are there, based on that, if I work out, I am getting 4.02. Obviously, when I apply 11% on 2.74, the answer what I get, and the answer what I get when I apply 11% on 4.02, the both are not going to match. So, which one is right? Which one is right? For that, I'll show you the part in the standard with the language there. So, let's see here, guys. Coming to the concept book. So regarding general borrowings, the rules, basically this everybody must be knowing this anyway, but still just for safe side, first you have to work out an average rate, capitalization rate, which in our question, the question itself has told that this is going to be 11%. So that is something which we worked out. Second, calculate the expenditure incurred on the qualifying asset financed from general borrowings. So how much expenditure did you incur on the qualifying asset which is funded through general borrowings that you have to identify. Now how to work out this, there is a note given. This particular note, what you are seeing here, this is totally picked up from Ind AS 23. So instead of showing you bare standard, I am just showing you my concept book. Just see here. The amount of expenditure on qualifying asset includes only those expenditures that have resulted in payment of cash. So cash payment must be there. In case you did not pay, no problem. For the outstanding amount, interest you have to pay. Means that kind of arrangement if it is there, then I can consider accrued also. Otherwise the answer is you have to consider only those expenditures for which amounts are paid. No sir, I did not pay, I promise to pay in future along with interest, no problem. In that case I can consider that also. So either cash payment must be there, or in case cash is not paid for a service or good obtained, for the outstanding amount interest at least you should have promised to the other party. In that case accrual is also okay. So prima facie understand the standard ka point. Standard ka goal is to make you consider only those expenditures for which cash outflow is there, or cash outflow will be there in future along with interest to the other party, which means the standard is pretty clear that your preference is basically cash outflow. So in this case you have to apply your 11% rate on 4.02. So on 4.02 if I apply 11%, that's coming to 0.44 roughly. They have given a little high, lengthy answer, but you can understand and read all that, but example you need not quote all that. You can simply write that this particular point what I've just now showed you, the expenditure on which capitalization rate is applied, this is coming from Ind AS 23 marks. So this first point if you write and straight away say that I am working out on 4.02 into 11%, I got 0.44 answer, and 0.44 answer is correct. Let's accept. See, the goal is the amount of borrowing cost what you are capitalizing that should not exceed the actual borrowing cost incurred. The actual borrowing cost incurred is 0.5. So in no way I am violating the fundamental rule. So 0.44 is pretty correct answer. Okay, coming on to the next question. Okay, next question is a consolidation question which we will do in a while. Let's come to 20th, which is the last question, and then we will jump off to consolidation question. P Limited and Q Limited enter into a contractual arrangement to buy a building that has 12 floors. So P and Q, okay, although the heading is given a joint arrangement, example that heading won't come, but you must understand that then there is a contractual agreement and there are two parties, most likely it's going to be a joint arrangement case. So their goal is to buy a building which has 12 floors, and then they will lease it to other parties. P Limited and Q Limited are authorized to lease 5 floors each. Okay, and P and Q can unilaterally make all the decisions related to their respective floors and are entitled to all of the income from those floors. The remaining 2 floors will be jointly managed. Oh, wait there. So what he is trying to say is these people will construct a building or buy a building. In this building, 5 floors belongs to P Limited, another 5 floors belong to Q Limited. So this all decisions will be taken only by P in the first 5 floors. Here all the decisions are taken only by Q. But when it comes to the last two floors, the decisions, the remaining two floors will be jointly managed. All the decisions relating to these two floors must be unanimously agreed. So management jointly, unanimous consent also is required between P Limited and Q Limited, who will share net profits or losses in respect of these two floors equally. So whatever net gain or loss is there, they will equally share. That is, they both have, this is the golden line, they both have rights to the net assets of the arrangement. The leasing of the property is determined to be relevant activity. Relevant activity is important activity on which these people are having joint control. Whether this arrangement is a joint operation or joint venture. So it's a basic, it's a very basic question which is built on the fundamental point of Ind AS 111. See, if you conclude that there is a joint arrangement, the joint arrangement can be either classified as a JO, joint operation, or JV, joint venture. So there is a contract, correct? In this contract, these parties have agreed to construct or buy a building with 12 floors. First 5 floors, second 5 floors, they will take unilateral decisions. So parties have rights to individual assets of the arrangement. So the first 5 floors and the second 5 floors, they are definitely not part of joint arrangement because the decisions are unilaterally taken. But as regarding the top 2 floors or the remaining 2 floors, the decisions are collectively taken with unanimous consent. So this all indicates that the parties have joint control on the asset and all the decisions are also taken unanimously, and there is a contract. Therefore, we can conclude that there is a joint arrangement in place. The next question is whether this joint arrangement should be treated as a joint operation or a joint venture. Now, how will we know that? See, if you know, Ind AS 111 has got a structured question here. So, before we read that structure and all, the simple points are, if the parties are interested in individual assets or their share of assets and their share of liabilities directly, then we will call it as a joint operation. If the parties are interested in the net assets means what? The assets belong to the arrangement, but the arrangement also has the liabilities. The assets, after settling all the liabilities, if at all something is remaining or whatever is remaining, if parties are interested in the residual interest of the net assets, in that case we call it as a joint venture. So whether they are interested in individual assets or whether they are interested in the net assets, that will determine whether it is a JO or JV. In Ind AS 111, how this entire thing is framed is, the first question they will ask you is there a separate entity that is created for the purpose of this joint arrangement? Separate entity must be structured. If separate entity is not created, then it's straight away a joint operation. You cannot call it as a joint venture. So let me show you that also. Yeah, this is our Ind AS 111 concept part, sir. In that, if you read these 2 points, in joint operation, the parties have rights to assets and obligation towards liabilities of the arrangement. The parties are called as joint operators. But in a JV, the parties have right to the net assets of the arrangement. The parties are called as joint venturers. Now, how will I know whether it's a JO or JV? So, is the joint arrangement structured as a separate entity? If the answer is no, sir, we did not create any entity. That's all. The joint arrangement will become a joint operation directly. But in the given question, if you see whether these fellows have created a separate entity for managing these 2 floors or not, the question did not tell us. The question did not tell us, but the question is telling us that the parties are interested in the net assets of these 2 floors. The parties are acting with unanimous consent. So it's sounding like a joint venture, but the question did not specify whether a separate entity is created or not created. Okay, in case you create a separate entity, so does it mean that I am a joint venture? No, that will be a starting point. You can be a JO, you can be a JV if separate entity is created. After that, I have to check your legal form, I have to check your terms of the agreement what you people wrote, and you have to also see whether the joint arrangement entity whatever you created, is it capable of standing on its own or not, or who is eating the output of the joint arrangement and all. Based on all this, we'll decide whether it is a JO or JV. But the cardinal principle is, are the parties interested in the assets and liabilities, or the parties are interested in the net assets of the arrangement? In this question, if you see, the data is not very clear. The question does not say whether a separate entity is created or not. So answer basically how you can write is, after stating the provision, that chart whatever you have seen, there's in study mat also, the chart that points you quote, and ultimately you will say that if a separate entity is created, then definitely this is a joint venture, because unanimous consent and all is there, and parties are interested in the net assets only, not in individual assets and all. As far as the 2 floors are concerned, I am not talking about the first 5 floors or the second 5 floors, only the remaining 2 floors. In case a separate entity is not created, then it's very clearly a joint operation. It can't be a joint venture. So that's about this last question, question number 20. We have this consolidation question pending. It's a very simple question. So guys, let's finish off this video by finishing off this consolidated financial statement question. It's a pretty simple question. It's an old IFRS diploma question, which also came in exam in the past. So this is also there in also, I think this one, not this one. A similar question, the same thing. Question number 12. Anyway, on 1st April 20x1, A Limited acquired 80% of the share capital of S Limited. On the acquisition date, the share capital and reserves of S Limited stood at 5 lakhs and 1,25,000 respectively. So, share capital and pre-acquisition profits of the subsidiary on the acquisition date is given to you, which is nothing but the book value of net assets. A Limited paid initial cash consideration of 10 lakhs. So, you paid in cash 10 lakhs. Additionally, A Limited issued 2 lakh equity shares with a nominal value of 1 rupee per share at current market value of 1.8 rupees per share. So, apart from cash, there is a shares issue also. Okay. It was also agreed that A Limited would pay a further sum of 5 lakhs after 3 years. So, there is a deferred consideration as well. Deferred consideration liability also is there. A Limited's cost of capital is 10%. PV factors are given. Why PV factors are given? Because that deferred consideration has to be recognized at present value. Because it's a liability, effectively ACM is what we are applying. The shares and deferred consideration have not yet been recorded by A Limited. So, when you buy an investment, the investment in subsidiary, you have to record for outflow of cash, you have to record for issue of shares, securities premium, deferred consideration liability. But this fellow has written only the entry for cash part, non-cash part, the entry is not passed. So apparently A Limited ka financial statements are wrong. So what is the date of acquisition? Once again, date of acquisition is 1st April 20x1. The balance sheet of A and S Limited at 31st March 20x3 are given. So how many years are over now? 2 years time has been passed. Now why this is relevant is, since deferred consideration itself you did not record originally, on the deferred consideration, interest also you did not record for a period of last 2 years. So all that rectifications you have to make. So what do we have here? Okay, amount is given in thousands. We have PPEs, investment in S Limited at cost, inventory, receivables, cash balance. You have share capital, retained earnings, non-current liabilities, current liabilities. Okay, on the acquisition date, the fair value of S Limited plant exceeded its book value by 2 lakh rupees. So the fair value is higher than the carrying amount by 2 lakhs. Is directly the revaluation profit. The plant had a remaining life of 5 years. The consolidated goodwill has been impaired by 2,58,000. So goodwill impairment amount also they gave you. The A Limited group values NCA at fair value method. On acquisition date, fair value of NCA is given to you. Okay, let me check what is the original question on this. Original question is a similar question. You can see, so this is an IFRS question, IFRS diploma examination question. Same thing, this one also did not record the shares and the deferred consideration part. Numbers are also pretty much similar only. 5,500, 1,500,000, same amounts. Only thing is, in the question which came in IFRS exam, they spoke about a brand value of 2,50,000 also. Apart from this plant and machinery upward revaluation, there is a brand also which the S Limited did not recognize, but the parent company has identified that. So that also you have to do. Goodwill impairment amount is same, and say fair value and all is same. So let's quickly finish it off. Easy sum, very easy sum. See, first and foremost thing, question number 19. calculation of PC for 80% acquisition. See, the entire balance sheet is presented in thousands, so it's better we also do it in thousands only. So cash paid is actually 10 lakhs. Cut the last 3 zeros, write it here, 1000. Then add fair value of shares issued. Now, how many shares did you issue? It's very clear. The question is clear. 2 lakh shares is what you have issued. And fair value of your share is 1,80,000. Sorry, 1.8 rupees per share. So it will be 3,60,000 rupees. Outside I am writing 360 plus deferred consideration. You promised to pay 5 lakh rupees. PV factor is given as 0.75. So 5 lakhs into 0.75, that will be 3,75,000. So I'm just writing 375. So all put together, the total is 1735. So ideally in my SFS, I should have recognized investment account debit to bank, to shares, to share capital, to securities premium, to deferred consideration liability. But our fellow did not do that. He wrote only the cash part. So rectification entry in A Limited's SFS. So investment in S Limited account debit 735, because for the 1000 part they wrote the entry, the remaining 2 only are not accounted. To share capital, 2 lakh shares you have issued into face value apparently 1 rupee. It's 1 rupee only because fair value is given as 1.8, nominal value is 1 rupee per share is given. So that is 200. To securities premium, 2 lakh shares into 0.8. So that's 1,60,000, 160,000. To deferred consideration payable is 375. Sir, if I write this rectification entry today, after 2 years, will it be corrected? Partly yes, but not completely, because on the deferred consideration liability, interest also has to be worked out for a period of 2 years. So interest cost for year 1 on deferred consideration excuse me. So if you work out that, it will be 375 into 10%, that will be 37.5. So interest cost for year 2, because by now, by the consolidation date, it has been 2 years since acquisition date. So it will be 375 liability originally plus 37.5 also will get added into that. No, so overall this much into 10%. So that will be 25 into 4, 12.5 into, so it will be 41.25. So 37.5 plus 41.25 is 78.75. This one adjust to profits of A Limited, or else simply if you want to write an entry for sorry, entries and all exam point of view not relevant, but just for your understanding, This is not related to consolidation amount. This is not consolidation adjustment. This is SFS law error adjustment. We can mix and quickly do it, but let us demark it. Up to now, I did not start any consolidation sum, sir. This is purely rectification of error. Right, ma. Next, coming to consolidation steps. First step, so date of acquisition 1/4/20x1. The change, this is for a period of 2 years. The date of consolidation which is happening on 31st March x3 is as on today. So the question has given you the share capital of the subsidiary company as on today, which is 500, which is 5 lakhs, which is also 5 lakhs at the date of acquisition. So 500. Now coming to profits. What's the language used? Reserves or retained earnings? Straight away retained earnings. As you can see, the retained earnings today is 300, but when we entered, the retained earnings was 125. So today it is 300. Once upon a time it was 125. So evidently this 175 is the extra profit that subsidiary has earned after the date of acquisition, which is nothing but post acquisition profit. 625, 175. Our last column is 800. That's irrelevant for us actually. Now you see, ma'am, before you do any adjustment, since everybody must have already studied consolidation and all, at this stage your first thought process is go and check if there is any dividend adjustment. If any dividend is declared out of pre-acquisition profits and all, then you have to add it back in the middle column. If there is no such dividend, then check whether there is any time adjustment. Time adjustment means acquisition did not happen at the beginning of the year. Acquisition happened during the year, midway, from 1st July, 1st October, 30th September, something like that. But the question did not give you profits on the date of acquisition, but they have given you profits at the beginning of the year. In that case, the middle column what you get will be for 12 months period, but whereas your post acquisition period might be only for 9 months or 6 months. In that case, you have to transfer from the second column, changes column, to the first column some amount of profits. That is not there. So since that is not there, this is confident to the post acquisition profit which is earned by the subsidiary and which is still there with their books right now. So to this you make your consolidation adjustments. So first and foremost, there is a revaluation profit on plant, 2 lakh rupees. So 2 lakhs in hundreds per head, it will be 200. This is a pre-acquisition profit. But on this you have to provide additional depreciation, because had you recorded 200 originally on the depreciation group point of view, you would have done on that extra 200 also. For how many years? Entire post-acquisition period, which is 2 years. 200, life is 5 years, so 40 into 2 years. So that is going to be 80. And in the question, if you see, this is subsidiaries P&L analysis. No, so you will not be having any interest cost, deferred consideration and all are not here. The parent ka standalone mistakes. So that's it, my here. You can total it up. So if you knock it off, so this will be 825. So this will be 95. So this is your net assets on the date of acquisition. net assets lo change only is nothing but your post acquisition profit. In this, what is the share of what's parent company name? A Limited. Share of A Limited 80%, say 20%, 76 and 9. That's it, sir. With that, we are done with our first step. Excuse me. Step number 2. This is goodwill or capital reserve, which is a bargain purchase gain calculation. This entire calculation is done only on the date of acquisition. In this sum, you will not get a capital reserve because they have given impairment on goodwill. So, but anyway, so PC what you paid for your 80% acquisition, the total original calculation, which is 1735. You might have accounted wrong with that. I'll correct it now. But originally, what is the PC? 1735. NCA 20% on date of acquisition measured at fair value. Ind AS 103 gives you a choice of fair value or PSNA. This fellow has selected fair value, which comes to 3,80,000. So 380 minus fair value of identifiable net assets on date of acquisition, which comes from here, which is 825. So if you do this, so 1735 plus 380 minus 825, so that's coming to 1290. So 1290 is the prima facie amount of goodwill what you are getting. But on this goodwill, there is an impairment. How much impairment loss are they asking you now? Which is 2,58,000. So 1290 minus 258, it's going to 1032. So this is your goodwill calculation. This is goodwill in consolidated balance sheet. Step 3 is we working out NCA for CBS. So whatever NCA was there on the date of acquisition, which is 380, to that add share of post acquisition profits in S Limited, which comes to 9 minus share of impairment loss in goodwill. Because the goodwill is a full goodwill, because NCA on acquisition date is measured at fair value, any impairment loss in goodwill, even they have to take a share out of that. So 258 into 0.27. So this is your final NCA that goes into the balance sheet. Coming to step number 4. Other equity for CBS. Now, if you check the balance sheet of both the entities, they have only one item, which is retained earnings. But you should not forget that this parent fellow, when he issued shares, he did not record securities premium. So because of the rectification entry what we are writing, that securities premium also will now appear. So you will have one retained earnings, keep one for securities premium also. Balance in what's the parent company name? A Limited. A Limited books la how much amount is there? This one. 1400 is their retained earnings. That's a wrong number, but still it is there. Rectification of error. The first working note what we have done. From that, what rectification is there? You did not record securities premium at all to the extent of 160. So that you have to create. Not only that, you did not record interest of 78.75 on your deferred consideration. So that 78.75 interest, if you record, that's a cost on your liability. So your profit will reduce. So these are the net impacts of these rectifications. Of course, in the balance sheet, share capital will improve compared to what you have already written, but 1400 minus 78.75. So it's 1321.25 and 160. This is purely error rectification. I did not do any consolidation adjustment. Now, consolidation adjustment are share of post acquisition profit in S Limited, which comes to 95 la some percentage, 76. Yeah. Minus share of impairment loss in goodwill. Total impairment loss in goodwill is 258. That into our share, parent share is 80% in that. So that's gonna be 206.40. So ultimately in the balance sheet, we are going to have other equity of 1350.85. Share capital also change will be there, that will show separately, but overall this is that. That's all, sir. All the adjustments are done. We simply have to do a consolidated balance sheet. So coming to consolidated balance sheet. PP. Coming to PP, our PPE is 5,500, that follows is 1,500. But we have upward revalued it by 200 and we provided additional depreciation of 80 also. So it will be how much, sir? 7,200 minus 80, 7,120. Then goodwill. In our balance sheet, investment is there, and investment will disappear in the consolidated balance sheet, resulting into goodwill. But out of that goodwill also again we booked impairment loss, so ultimately goodwill is 1032. Now coming on to the current assets part. Coming to inventories, what do you have in 550 and 100? After inventories, invariably we should write financial assets. Under financial assets, they have trade receivables and cash. No adjustments in any of them. So asset side we are sorted, sir. This asset side total comes to 9652. Coming to the other side, equity and liabilities. Under that, under equity, first equity share capital. Only parent company's equity share capital will come, which is 2000 plus working note number 1, rectification of error, another 200. So total it is 2200 ultimately. In the balance sheet, it is sufficient if you simply write other equity. The breakup is already provided in the note, so final 1350.8. 1350.85. Non-controlling interest separately we can show. Whose number was 337.4. Let me check this one. 380 plus 9. 337.4. Then you have non-current liabilities. Now what do we have under non-current liability? Oh, they did not give you the breakup and all. So simply add them. See, deferred consideration is there, but deferred consideration is not a non-current liability because you promised to pay money after 3 years from the date of acquisition, and date of acquisition happened 2 years ago. So now deferred consideration actually payable 1 year from where we are standing, so that will be a current liability. So 3000 plus 400. The breakup of these non-current liabilities we do not have. Now coming to current liabilities. So current liabilities 1250 and 650. These two are anyway there. Apart from that, you should have recognized initially deferred consideration liability at 375, and on that 78.75 also. So 375 plus 78.75 also. So all put together 1250 plus 650 plus 375 plus 78.75, 2353.75. That's also totaled up plus 3400 plus 337.40 plus 1350.85 plus 2200 9642. Oh, there is a small difference coming. Let me check once. Oh yeah, small error, sir. Not error, small thing. 95 into 20% is 19. I wrote 9, so that will be having a small 10 rupees adjustment here. So it will be 347.40. Yeah. Nine six five two. So guys, that's all with your balance sheet and RTP November 24. So guys, prepare well, do well. I hope this video helps you in your preparation. Although there is nothing pretty much alarming and all, so there's nothing to worry or incrementally learn too much from this RTP. Anyway, happy preparation guys. I'll come with another video on MTP. Thank you sir, thank you so much.